Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, July 13th, 2022. Just really a follow-up. I wanted to just put my thoughts, just make sure if they're not clear already, just share those thoughts again with you on the inflation numbers that came out today and why I modified my strategy. I told you I didn't really want to see QQQ go below 285, and of course I still didn't want to see that. But what I did, instead of stopping out on any positions, I watched things. I knew the report was coming today. Saw what I believe to be well, we can call it a knee-jerk reaction. That's not the term I'm looking for. More so a false report on the CPI. And look, when I say that, I've always, for years, like many others, I'm not the only one who's criticized the CPI for being grossly inaccurate, often very, very lagging. And I looked this stuff up, and I know this. I've been in the financial markets for years. The way the CPI works is the government has a whole team of minions. The BLS has a team of minions, employees that go throughout the country, and they go into supermarkets and doctors' offices. And they check prices on a whole basket of goods and services, and I did verify this. I've known this to be true, but I verified it. It's throughout the month. It's not a spot reading, so keep that in mind. It's average. It's going to be an average of prices throughout the month. So the CPI data that came out today was the June report for the month of June, and I'm going to go over that in 1 second. But I'm going to show you this is what's being reported. So the key takeaways, and of course I look at this because I realize what I've been focusing on is primarily commodity prices, including energy. Now they are some of the biggest there. Housing markets I look at too, but that's hard to get more. That's very hard to get real-time information. We know rents are going up, but that's not what they're citing. They're citing the huge increase was broad-based, as they said. It was a broad-based increase, with the indexes for gasoline, shelter, and food being the largest contributors. Okay, so and then they cited the energy index rose 7.5%. Over the month, and contributed to nearly half of the all items increase, with gasoline index rising 11.2% and the food index rose 1. Now, let's look at that. Okay, let's tear that down. Now, these are hard things. Now, I do know that when the BLS employees or, the government employees go into, Publix or Safeway, whoever your supermarket is, they're not looking at the price of corn futures or soybean futures. I do know that. So there's going to be a lag. They're going to look at the price of corn on the cob or corn puffs, corn chips, whatever. And so I know there's going to be a lag there between when the producers lower their prices or at least stop raising prices. So that is why inherently you're going to get a lag in the CPI. But however, energy is direct. So let's start there. And then I'll get back to the QQQ chart. So let's go to USO, which is a very good, accurate proxy for crude. We're just looking at charts here. And let's just look at the time frame here of when this drop occurred. Okay, so here's the month of June, and this is crude oil. Big one here. There's June 1st right there. So from June 1st, crude rallied another 7 days, about 7.5%. And at the end of the month right here, let me get the July 30th is right there at that candle. By the end of the month, it was down throughout the month. A total of, you can see the pop-up box to the left, that's 6%. So the majority of the month, we had a little blip here up, but mostly down to close the month down, and that would have 110%, if it was an accurate measure, said there was a significant abatement, drop in energy prices. Gasoline's a big one because that weighs pretty heavy in the CPI, because remember, it's consumer price index. It's the price that we pay. You probably don't know many people that went out and bought a barrel of oil lately. Maybe they bought some motor oil for their car, but of course that's a refined product. There's a little lag there. But here's gasoline. This is real-time stuff. These are gasoline futures. They're going to pretty much mirror the prices of gasoline here. And so let's just look at this. Okay, I got to grab the candle right there. That's my June 1st candle. So on June 1st, gasoline prices went up for another 2 days, peaked on June 3rd right there, the gasoline futures at about $80. The high was $80.17. and then fell. We matched about an equal peak, a little lower. And here is the last day of the month. Let's see if I can grab it there. There's July 1st, that little pop. So there it is. So we ended the month down. This is from start to finish, drop of 11.6%. And I see nowhere in here, even if you took an average throughout the month, where we had an increase. In fact, again, as I said this morning, we had pretty much the biggest commodities broad base. It was the biggest drop in years without a close second. So we've had a couple spikes down in energy, and they were, brief. But when you look at the broad commodity index, the one that I've been using because it is the most representative, this is my real-time tracker, my real-time inflation tracker, and that's DJP. And you can see it right here from top to bottom. Oh, nope, I need to go to the month of June. Let's be accurate with this. There's June 1st right here. We went up for about a week, and then by the end of the month, let me grab, that is it right there, that candle. We closed down 12.9% for the month on DJP, which again is to me the most accurate, diversified, broad base, one of them out there, index, tracks the most accurate index. So the government's telling us we had the hottest number in 40-something years in the month of June. This is broad base. Again, you have, as I've showed you and talked about it before, let me turn all the notes here. I haven't updated recently, but you have everything in here, energy, grains, oil seeds, precious metals, livestock, so very well diversified. And again, I will say that, as I said before, prices at the grocery store aren't going to drop right away. This doesn't include services, hospitality, hotels, or whatever other services are in there. I'm sorry. And it doesn't include rent and all that, which we know was going to. But again, they were citing energy as being the largest component there. So, see, I think, and here's the thing, guys. I know not everybody on Wall Street's super smart, but I'm pretty sure there's some pretty smart people up at the top, and I think they'll see this and also know. So what the Fed's going to do, the implied reaction was the Fed's going to come in super aggressive. These are super hot numbers. They're going to have to every bit of the 3/4 point, and that's probably priced in, but the pendulum's going to swing the other way. And as I told you yesterday, based on my analysis, so I am not a conventional trader. I will modify my plans, my stops, and that's what I'm doing with the QQQ trade. This is what I forecasted yesterday. Forecast a lot of this move down, but I think we'll see another drop. I don't think the drop in DJP and commodities and energy and everything is done, at least till we get down to this $31 target. So we had the breakdown, the back test, which coincided with those back tests on crude oil and natural gas, which again is one of the biggest weightings in the index. Energy costs is a big one. Most people can't skirt around that, and it permeates to just about every level in the economy. From the cost of the FedEx package or Amazon Prime delivery coming to your door, because planes have to fly that stuff. Planes, trains, and automobiles are getting those packages to your house. They're getting to Walmart, even if you drive to Walmart and buy your stuff still nowadays, or wherever you buy it from. And so energy is a big one, but that's it. So this is broad-based abatement, and we can just rifle through them. This is what I did the other day for you, but you can do it yourself and track these commodities. You can look at the price of soybeans, see one of the biggest drops in years, especially that quick ascent. And again, that was ironically was just pretty much the month of June where most of those drops came. There's wheat. Wheat's obviously one of the biggest cost input food costs. It affects everything, most things that people eat, and of course livestock as well. So that translates ultimately over into the grains, that is, corn as well. Corn's been falling and everything else. So I struggle to find any commodity that rose in price, or I struggle to find any commodity, I should say, food or energy, that didn't drop significantly in the month of June. And again, I just think that it's the usual, just behind the curve, inaccurate, old, antiquated system that the BLS uses to calculate um, the rate of inflation. So there we're at. Some things may bounce soon, but then again, we could let's just say, well, let's just go with this theory because I'm on a working theory and it's a moving target, moving. I always say my analysis is dynamic. Charts change day to day, and so will my analysis. So, if I am right, then we come down and we have sooner or later this big drop in June, especially July. And if you get a persistent, a larger drop, that's where you have more and more where pricing pressures will then permeate back. Number one, what it does to the end user products. Again, the cereal box on the shelf that you're buying, or the can of soup. It certainly slows down or completely eliminates the pricing pressures, the ability for those producers to raise price. The market's going to start pushing back on that. Number one, they've already pushed through a lot of price increases. Everybody knows about inflation. You guys, I'm sure you've read about shrinkflation. That's probably the biggest thing going on right now in the supermarkets. Shrinkflation is the sleight of hand that a lot of the food companies use. General Mills has done it. Just about everyone's done it. But take a box of cereal, which we used to be, I don't know, whatever it was, 16 ounces, and now it's 14.3. It's the same box you've been buying for 30 years, but there's just less content in there. Chobani Yogurt did it. They've all done it wherever they could. So that's the shrinkflation part. And I don't even know if the government's been able to accurately capture that or not. Wouldn't surprise me if they haven't. Anywho, so that's it. I'm not going to beat a dead horse. That's what I see happening. The government's reported that this happened in the month of June, and so I think we're going to get, the Fed. We all know the Fed's going to hike, but it's a matter of will they pendulum swing too far. And then the other thing to that too, keep in mind, is with the Fed continuing to talk about raising rates and talk about rates going up even more. Remember, this is what's going to be the next thing that's going to check. There's always these reversions to the means in the financial system. U.S. dollar's been spiraling, right? And that is because we know the Fed was out front, the U.S. Federal Reserve, European central banks, Japan, they were all, much more, have been, remain more dovish than, or less hawkish than the Fed. And so that's why the dollar's been soaring, one of the main reasons. When our rates go up, then the dollar is more attractive because we're paying higher interest rates on U.S. dollars here. Now you can see the big bearish rising wedge. You guys know my thoughts on the reversal here, but at some point soon, and the Fed's going to have to contend with this. This is going to put a real crimp on the U.S. stock market because countries typically want a weaker currency. When the dollar is rising and the dollar is strong, it hurts our exports, especially your big, large cap multinational companies, those that export a lot of products. And so this ultimately is going to put some pressure on those big cap companies, and the Fed's going to hear about it, and they're also going to bait. So anyway, you can see it's in the charts. This big rising, this is a big bearish rising wedge in the dollar, just like you have that breakdown, what I believe will be a false breakdown in the euro. And here's the primary trend line. Again, I talk about mean reversions, especially with currencies. They always get way ahead of themselves, and the pendulum swings too far in one direction, and then you get a trend reversal. And so we'll be watching for this one. It's going to start with a breakdown of this steep uptrend line. Looks a lot like that last final wedge that we shorted in crude when we got the first sell signal there. Then you have a secondary trend line. So you break that, you come down here, you bounce on this one for a while, and then ultimately you're going to come down, even if the dollar remains in a bullish trend, back to the primary trend line. This is a more sustainable rate of ascent right here. But ultimately, all trend lines break and you get a major trend change. But even this, that would be a big down in the dollar. And I think this will come when the Fed realizes that they've done a little too much, a little too fast, front end loaded, and they start backing off their hawkish rhetoric and the dot plot changes. So that's it. And then back to the charts. Let's just end it here. QQQ, go to the 60-minute chart. I added, since that chart I got out to this morning, I added a trend line here uptrend line off the lows right there. You have several reactions. It was already validated there, and this is the dip. This is a dip that I fired off that email. The post buying the dip, and so far that's another reaction because they bought the dip. That's the trend line to watch right now. And I think it will be very, very big if we get back above 285, because I told you before, 285 was a big level to me then, still is now. And if we get above it, then that would be a big old stop. That would be quite bullish, because that would be a stop clearing move, aka bear trap, what these things serve to do. And I'm talking about something that hasn't even happened yet. So we'll just take it one day at a time. Let's see how we close today. But this right here has the potential, undoubtedly cleared out a lot of stops, undoubtedly also pulled in some more shorts. And so if the market can power back above 285, that's where likely those stops on the short sellers will be hit. And then that's what will also likely bring in some new long side, some bulls, long side natural buyers as well. So this is what I'm watching for today. If they can't get anywhere near there, then the lot that I added to here, I'm going to just muck that hand, throw those shares away, hold on to the rest with this is the new level to watch, I think, right now. But look, this is still, you still are well off the lows. Remember that. This is what you get in a volatile and a bear market with volatility high. You had the CPI numbers today. You've got JP Morgan Chase tomorrow, the biggest financial institution, reporting in the morning. Then the rest of the banks on Friday. So you can expect some volatility. And we're just and with JP Morgan tomorrow, we're just kicking off earnings season with weeks more to come. So expect volatility. But as of now, and again, just as of now, we have the makings of a near-term uptrend, which is 3 higher lows, and so far we had higher highs. And so if it might be some tough sledding, might do this, but if we can get up there, again, first things first, one thing at a time. If we can get back above 285, great, should be a check mark. If we can't, that's not a check mark, that's a little X, whatever you want to call it, check mark for the bears. And but you still have a lot of support here. So anyway, so the takeaway, expect choppiness with earnings coming up, but as of now, and that's why I fired that post off to you this morning, and I wanted to do the quick video just to get my thoughts out that that's a dip that I think should have been bought. And you can see there it is. It came out at the open, and so far, the day's not over. It's very early, but to the tune of about 1.7%. So you talk about an overreaction. The majority of the dip's already been bought up. We're back down right now, but we're still off this morning's lows about 1% right now. And you want to talk about a bullish event. If all this gets faded and they can get back above and turn the market green, whether it's today or sometime tomorrow, that's going to be pretty darn bullish, because all these, like I said, what it serves to do is clear out on the long side, clear out what's referred to as weak-handed longs, and then those that didn't get stopped out this morning, they're stronger hands. So are they going to sell when we get here? Absolutely not. Like me, I'll be adding again if I decide to add any more dry powder. Went in pretty heavy, mainly as I don't want to say a day trade. I'm just going to tight trail those stops up now. And as I told you, if we can't get close to the 285 level by the close, I will sell probably the bulk, if not all, of what I have today, and then still sit tight with the rest of the position. I'd like to see what JP Morgan does tomorrow, so I'm giving things a little bit of room for right now, because again, it all goes back to both the recent price action and the technicals when I look at the daily and the weekly charts, and I also factor in fundamentally what's happening right now, and including the inflation data that I just showed you. That's not very accurate in my opinion. But again, it was lagged the other way around. We've been seeing this inflation coming. I've been talking about it for the last couple of years, as others have. Fed was completely dismissive of it. So it just goes to show you have to expect that the Fed has always been and will always be behind the curve. All right, I'm going to end it there. Get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.